What's up, everyone? It's Kadi with Money Vesting. I don't even know how to start this video, how to go about this video, because the more we unpack about what's going on with the Federal Reserve, the more crazy it gets. So I actually shared this chart, or pretty much did a video about this and the Fed's balance sheet in terms of total assets going up on a week-over-week basis by almost $300 billion. So they pretty much lent out some capital to the banks that needed it the most. And as a result, even though their mortgage-backed securities and MBS products, their mortgage-backed securities and their U.S. Treasuries did fall over a little bit, so they did decline on a week-over-week basis. The Federal Reserve's balance sheet in terms of total assets increased because of the lending that they did in the past week. And this is pretty much over the last year or so, all the quantitative tightening the Federal Reserve has done from a balance sheet standpoint, it's pretty much given back nearly given half of it back in just 1 week. In other words, the Federal Reserve has been taking one step forward and two steps back, in my opinion at least. But I wanted to go over in more detail because there were a lot of other questions, and also I let you decide in the comment section below whether you believe this is part of quantitative easing or quantitative tightening. I'm going to be thinking out loud in this video to kind of address that as well. Very quickly, I want to go over what the Federal Reserve does, and of course, what are some of the ways they can lend money out to other banks and financial institutions. So as we already know, the Federal Reserve controls monetary policy, right? So they want to make sure that inflation is stable and employment is strong. So price stability and the labor market are their dual mandate in terms of their monetary policy. But they also lend money to other financial institutions and banks. And one of the primary ways they do that is through the discount window. So the discount window is a lending facility through which banks can borrow funds from the Federal Reserve for short periods of time, usually overnight, to meet their reserve requirements or to address temporary liquidity needs, right? So if any banks don't have the funds to meet their reserve requirements or are running low on deposits or running low on their liquidity, they can borrow from the Federal Reserve on the discount window, and they can borrow it using a discount rate, right? So the Federal Reserve actually is charging these banks a discount rate, and currently that discount rate is sitting at a little bit over 4.75%. So that's how much they charge these banks. And other methods are going to be these term auction facilities, in which the Federal Reserve auctions off funds to banks for a set term, typically a few weeks, and also accepts collateral in return. And repos, or which is repurchase agreements, are a little bit different as well, when the Federal Reserve buys government securities from a bank with an agreement to sell them back at a later date. So in other words, if a bank is holding on to a mortgage-backed security or a treasury bond, what the Federal Reserve will do is that they will buy them from that bank, and they will then exchange that for money, of course, because the bank needs the money. So they will give them the funds that the bank needs, they will buy them the securities, and then they will sell them back at a later date when the bank is hopefully in a better situation. Now, I put this question over here as well. Can the Federal Reserve print money? And the answer is yes. They obviously don't physically print it, but they do print it, on an electronic basis, on a more digital basis. So the actual, of course, physical printing is done by the Treasury Department, which is going to be the engraving and the printing bureau. But the Federal Reserve, on the other hand, has the authority to create new money electronically through the process called open market operations. In this process, the Federal Reserve buys government securities such as treasury bonds and notes from banks and other financial institutions. And to pay for these securities, the Federal Reserve simply credits the accounts of these selling institutions with new reserves, which are essentially new electronic money. So it's like, billions and trillions of dollars electronically just magically appearing on these computer screens. Now, this right here is a brand new program. The brand new program the Federal Reserve is going to be launching. It's called the BTFP, and that is going to be Bank Term Funding Program. It kind of sounded like buy the dip, but it's not really. It's not BTD, it's BTFP. So it's Bank Term Funding Program, and which is going to be offering loans for up to 1 year in length to banks, savings associations, and credit unions and other eligible depository institutions, pledging U.S. Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as collateral. So again, it's going to be something very similar format to TAF or repos, but instead the borrowing banks and institutions and credit unions will have to pledge their existing securities for up to a year, and use that as collateral in order to get the funds they need from the Federal Reserve. Now, this is a much bigger problem. I will explain exactly why that is. But the federal discount rate, we already went over that. And this is the discount window borrowing, which has spiked to its highest level since, well, 2008. 2008, we had the great financial crisis. That was the highest level from back in those levels at 110 billion. And right now, March 15th, we have seen about $85 billion worth of borrowing from the discount window amid the Silicon Valley Bank failure, and of course other banks also following suit and kind of following up with that as well. So this was the report. JP Morgan suggesting that the Fed may provide as much as $2 trillion in liquidity relief for banks after the Silicon Valley Bank collapse. And it's kind of tying it back to the new program that we have, which is Bank Term Funding Program, BTFP. If you kind of read this report, and by the way, we're going to come back to this in a minute, but if we kind of read this report here, the BTFP will allow banks to obtain liquidity by putting up their bond holdings as collateral. The Fed will accept the bonds at face value. It's pretty crazy. If you kind of read that, in their press release as well, if you go back and read this, it pretty much says that these assets will be valued at par. You know what the problem is? A lot of the banks are holding on to their bond portfolio, their MBS portfolio at heavy losses, right? So they're not making money on it because they bought them, years ago, and interest rates have gone up. So the market value of these portfolios, the market value of their bonds and their mortgage-backed securities are sitting on heavy losses. And it's quite crazy to think that the Federal Reserve will allow these banks to borrow money against their securities, which are at heavy losses, and they will not mark to market them, but instead mark to par, or in other words, value them at par, at face value, at which they originally bought them, the banks did, and allow them to lend. For example, if a bank has $10 million in MBS and treasuries, that's the face value. The Federal Reserve, after taking a haircut, after allowing for that margin of safety, might lend them $9.5 or $9 million against that collateral, even though the market value of those bonds or that collateral, so to speak, could be much lower than what the face value is. Could be far lower than what they're borrowing. So that's exactly what's mentioned in that report. Is the Fed will accept the bonds at face value instead of the current lower market values that weighed on SVB's holding. Although no official quantity has been put on the BTFP by the Fed, JP Morgan put that around $7 trillion is how much banks could potentially end up borrowing. But that 5 largest banks are unlikely to use this program because they're well liquidated, well capitalized, bringing the amount the Fed will actually provide closer to $2 trillion. It's kind of an insane bailout because these banks made investments in bonds and US treasuries. Those are underwater, right? And the Fed is willing to take them off their balance sheet at face value and lend them money against it, which they can then go out and start lending or buying assets at higher interest rates. It's mind-boggling. The volume of liquidity would help loosen financial conditions after a year of aggressive rate hikes. In fact, the Fed's monetary policies have worsened the reserve scarcity in the U.S. banking. The scarcity issue is made more problematic by an uneven distribution of liquidity. Of the $3 trillion reserves held by U.S. banks, almost half is concentrated among top 5 banks as well. So again, we talked about the balance sheet, right? Growing on a week-over-week basis. And this right here was a tweet from Danielle, which was quite interesting to read. There were a lot of debate. There was a lot of conversations underneath that tweet in the threads. But she pretty much mentioned that before any of more misinformation spreads on what I sometimes call this damn platform, which capitalizes on sensationalism and misinformation, which is, again, Twitter. This is why the Fed's balance sheet grew last week by $298 billion. The discount window at the Fed is open, something that we discussed. The discount window is what allows the banks to borrow from the Federal Reserve. And discount window borrowing increased $140.5 billion in 1 week, totaling $152.8 billion. Prior weekly record, $111 billion in 2008 during the financial crisis per business. I don't know why it's showing a little bit of a lesser number on Business Insider, but that number is obviously a lot higher, and it's actually eclipsed the highs from back in 07, 08. And additional funding of $11.9 billion was borrowed from the Fed's new Bank Term Funding Program. Now, $142 billion in Fed loans, quote, includes loans that were extended to depository institutions established by the FDIC. The Federal Reserve's loans to these depository institutions are secured by the collateral, and the FDIC provides repayment guarantees. $7 billion in treasuries fell, and $2 billion in mortgage-backed securities rolled off the Feds as part of the Fed's ongoing quantitative tightening program as well. So while that's all well and good, and I totally get that this is not an actual, the Fed is not going out there and starting to buy U.S. treasuries and mortgage-backed securities like they did during their quantitative easing program to keep interest rates lower. If you think about it, really, it is almost the same thing, because in this case, the Federal Reserve is not actively going out there buying directly from the market mortgage-backed securities and U.S. treasuries. What they are doing is they're lending to a bank who did buy U.S. treasuries and mortgage-backed securities, and that's what they're putting against as collateral. So, in other words, the Federal Reserve is using that, like they're literally lending money out to other banks in exchange for collateral, which is mortgage-backed securities and U.S. treasuries, back on their balance sheet. The market value is a lot lower because they're not doing it at market value. They're doing it at par, at face value. So again, I'll let you decide if this money, if the money that they are lending out to these banks, if that's going to ripple back into the economy some way or another, if that's actually going to be inflationary or not, if this is actually quantitative easing or not. I'll let you decide. I'll let you make the decision. But in my opinion, it is a very, very different process the Federal Reserve is actually following. And another thing that we have to consider is that where is the additional capital coming from for the Federal Reserve? Like where is the money coming from, right? They are going to have to go to the open market, once again, open market operations, and they will credit the borrowing bank with the electronic funds in exchange for the collateral, which is U.S. treasuries and mortgage-backed securities. So in other words, they are going to be printing money in order to make sure that they have enough liquidity to provide to the borrowing banks. So let me know in the comment section down below, what do you think? Do you believe that this is in fact QE or QT or something in the middle? I would love to know from you guys as well. But in my opinion, I feel like this is a very, very different form of QE, because the Federal Reserve at the end of the day is still injecting money into the economy. Whether this money makes it into the hands of the businesses and individuals and consumers, that is still yet to be seen. We don't know. If it does, then of course there's going to be more spending. There's going to be more inflationary pressures. But if this is simply there to just for these banks to meet with their liquidity requirements, these reserve requirements, then it's a different story. But at the same time, the banks certainly have more of a reason to pay back the Federal Reserve at 4.75%. But then again, if you consider, what if they take this money and then invest it into the treasury market or something that can yield a little bit over 5%, considering how high interest rates are, then they're making that spread, and their net interest margin is still pretty good, even though their discount rate is 4.75%. So there's a lot of different ways to look at this. Let me know in the comment section below, what do you think? As always, if you enjoyed this video, hopefully you got a little bit of a better understanding and explanation of what's going on. But let me know in the comment section below. As always, happy investing. Make sure that you drop a like, subscribe to the channel. I'll see you guys in the next video.